Hello, everybody. Good afternoon, good evening, good morning, and welcome to our next session where we're going to chat about scaling tips with Ben Narasin, who last week was venture partner NEA, New Enterprise Associates, but this week we have some new news, right? Ben, you have a new fund. Could you share us the whole story? The cat is out of the bag.
Yeah,
Welcome.
actually, thank you for having me. Today is formally my first day having spun out of NEA with their support as my first committed major investor limited partner to start a new fund focused on seed. Well, I spent about 10 years doing exclusively seed investing and about 5 years as a venture capitalist. And, seed is something near and dear to my heart, and it's where I've always enjoyed, and it's not the easiest thing to do inside of a large fund. So creating an outside fund seemed like the right opportunity. So when the management team came to me and asked me to do it, I was super excited. So today is the official first day where I go out and talk about what's going to be called Tenacity, my new fund focused on seed and pre-seed investing.
Awesome. Tenacity. And what do you have the scope, or what's the investment thesis? Is it already done, or?
Well, yeah, ultimately, I'm a generalist. I look for entrepreneurs that make me say, wow. I look for huge markets, great ideas, and phenomenal teams. And, I will invest anywhere from formation through pre-seed and seed, any first logical place to help entrepreneurs have the capital and assistance to get to the point where they can raise a high-quality Series A. Mm-hmm. So, historically, I've funded over 100 companies, and it's been everything from I have certain swim lanes, so to speak, that I do a lot more in. Fintech has been very successful for me, marketplaces, but I've also done consumer products, consumer devices, mobile. So, I would say the areas I don't focus on traditionally are the hard side of med tech, security, and deep in the stack enterprise solutions and open source.
Okay. And then do you have any geographical restriction, or is it global or US focused or something like that?
It's pretty much everywhere. I would say the majority of my investments come locally to me in the Bay Area, but, I've covered the world. I have people from, Europe in various parts, South America, Asia. So there's been no limits to where I can go, particularly now that everything is done in this manner.
Yeah,
exactly. The glass box, and I can meet entrepreneurs anywhere.
Yeah.
Last week I was judging startups. Actually, Nordic startups was last week. So, there's lots and lots of opportunities to get in front of entrepreneurs all around the world now, and for entrepreneurs to get in front of VCs. In fact, I launched a portal, pitch-ben.com, so that any entrepreneur anywhere in the world can pitch me for a minute by video, and I promise them a video response. I'm not always the quickest because it does get backed up, but I promise that I will give a response. And it's often advice, but sometimes it's follow-up for potential investment.
Okay. Awesome. Hey, congratulations, and wishing the best of luck for this new Tenacity VC fund. Yes. All right. Let's get to the topic of the day is like tips for scaling. So let's go there. And as an investor, of course, you are looking for those scaling opportunities to make the big returns everybody wants. So what kind of things or areas do you look very first, when you are estimating the potential scale of a certain business or a company or like that?
Yeah, it's a very reasonable question. So I always say, and I sort of hinted at this earlier, I need 5 things to make an investment. People, a great idea, and a huge market if it works. So the people part, the natural filtering process of entrepreneurship tends to get you pretty high quality people. Mm-hmm. But what I don't do is I'm not looking to sort of invest in smart people that haven't figured it out yet and hope that they pivot into something. I want to invest in the idea they're going to pursue. Okay. And I want great ideas, but I also need them to turn into really huge markets. And when you think about scale is often a function or in some ways maybe limited by the size of opportunity you're attacking. So if you are pursuing a market that in total is $2 billion, well, you're going to have to take half of it for people to care in the venture landscape. Yeah. But if you're pursuing an opportunity that, like as an example, I have a company called Transfix that's in the full truckload shipping business. In the United States, that's a $600 billion market. So, they've got a lot of room to grow, and they were sort of the first out of the gate to go after that category. There weren't competitors. So, it's ultimately, you need huge markets to achieve scale. Then you have to have a team that can execute against it and be comfortable with what my friend Reid Hoffman has coined the term hyperscaling. And this is about creating that engine of being able to feed the machine of the sales organization with the qualified leads to get to the opportunities, like getting a system in place, whether it's self-serve or freemium or enterprise sales. All of those things can work, but ultimately you have to have something that really just allows the organization to grow at a pretty torrid pace. And that part is why the people are so important.
Yeah.
Because it's interesting. I spent a lot of time in Europe, and one of the questions that often comes up is, hey, you've got great entrepreneurs and you've got great engineers. What does that middle management team look like? How many of those people? And so it was interesting. I was in Germany looking at a company and talking to people that had moved their businesses there and spent a lot of time there. And they said, well, our biggest challenge for hiring is hiring people that have already learned what hyperscaling is about. And so in their case, they said they would often reach out to recruit out of the UK, where there'd been a longer history of sort of hypergrowth startups to recruit from. But having the people with the talent to know the small details that it takes to effectively get into that high-paced growth scale is pretty critical. So that's why I go back to people. The right team is incredibly important. There's hundreds of little sayings I've learned in venture, and one of my favorites is A's hire A's and B's hire C's. So, getting an extremely talented and strong team at the top is critical to making sure that the team throughout the organization is developed at the highest possible level. And that's what you need for tremendous scaling, because when you've got that really exponential growth, it creates a lot of stress on the organization. And, it's the old saying about the weakest link in a chain. So you need to have really strong teams with the right experience wherever possible.
Well, you kind of describe it with your hand already there, and all the famous from every single startup deck in the history of the world, like the hockey stick and the hockey stick quote that every entrepreneur will have on their decks when they're pitching to investors. So what's the reality behind post the first pitch, and when the 1 year, 2 year mark, 3 year come, we are 50 times, 100 times, we're super profitable? What's the reality behind the hockey stick?
It's funny. You're right. Pretty much, there's certain things everybody has in their deck. They have a hockey stick, or they have one of the managing general partner of NEA, Scott Sandell, likes to see a 2x2 grid, and everybody needs to be up and to the right. I think that comes from a history of like BCG and Gartner. I remember, I'll tell you a quick story, and this is where I think it goes to both your last question and your current one, and then we can talk about what it looks like over time. One of my entrepreneurs was getting ready to raise his Series A, and he brought me his deck, and he showed me his hockey stick chart. And he's like, how does it look? And I was like, well, I don't know. I can't really tell. We need to go through the assumptions. And he's like, no. I just mean, visually, am I showing them the right curve? And I said, well, let me explain something. That would be like putting two cakes in front of me, beautifully iced cakes. But I don't know if one's filled with sawdust and one's made out of flour, butter, and sugar. So until I take a bite, I can't tell you. So until you show me the recipe, I have no idea what the curve looks like, because what's underneath it? Just sitting there and drawing a swoosh on a page isn't going to cut it. So, it tends to be one of those areas where people drill in the most. You're looking for unit economics. You're looking for the underlying realities of typically these things boil down in an overly simplistic way to, let's call it CAC versus LTV, the cost of acquiring customers and the lifetime value of those customers. I'm even more focused on things like CAC versus recovery. How much do you spend to acquire a customer, and how long does it take you to recover that amount of money? Because, their businesses, and I had a business that just exited for about $2.5 billion, and their recovery period was, longer than a year and shorter than 2 years. But then again, the value of those customers was stunningly huge. And in the fintech space, that's viable. But generally speaking, I want to see your recovery as fast as possible, and really prefer under a year. I know folks that have got recovery that's immediate. You pay $20 to acquire a customer, but the customer makes you $35 of profit. Well, that's a great business to be in, because then you have a flywheel. And that really empowers that kind of exponential growth, because if you're constantly needing more capital to fuel the engine, and you certainly will if you're growing fast enough, but if it's like, if it's an arbitrage game, that gets very hard. So I think it varies. Life's not perfect. I'm looking for entrepreneurs that make me say, wow. And so that's what I fund. It doesn't mean it always works out that way. I think I've been doing the analysis of my own portfolio over the last 13 years. I've invested in over 100 companies. And I have been crunching those numbers sort of always. You're always trying to learn from your own experience. And I used to say that over half my companies that I seeded went on to raise Series A's from Tier 1 firms. But now I've actually run the numbers, and it turns out it's a lot more than 50%. It's between 61 and 73%. And I'm very proud of that number because I've actually never heard anybody come close to it. But that would be, so take the other side of that. If 60% raised Series A, obviously the other 40% did not.
Yeah.
And if they did not, it's probably because they never hit that hockey stick. They never hit that scale. Sometimes we're all projecting into the future, and projecting is an imperfect art. So, you see it all. You see people that, let's put it this way. I say this to entrepreneurs all the time. Nobody makes their plan. Everybody misses plan. It's just a question of to which side. Usually you miss plan because you don't make quite as much as you thought. But sometimes the ones you really get excited about. Divvy, the company I mentioned that I led the Series C for that just sold for $2.5 billion to Bill.com, their growth has been just torrid. It's been phenomenal. Really, really, really strong. And their growth was really strong when I funded them, and it's continued to be very strong. So, those sort of things get people very excited, and they show them the opportunities, and they're rare. If you look at public companies today, the public companies that have done the best are a combination of two things: tremendous growth and phenomenal margins. And if you don't have those two things, it's really, really hard to get the attention of the public markets and to do well in the public markets. So, when you make it through that very, very, very tiny hole in the needle to get to that, both growth and margin, and at scale, really large scale, that's when people just want a piece of it, and they just, can't get enough. So that's what success looks like these days.
Yeah, and then a little bit further on that same that when you see the growth with the cost of profitability, like we see in this crazy, let's fund the growth and never get profitability. So what's your, let's say, personal take on that? You don't have to put science.
Yeah, that's fair. So I think there's a little bit of a misnomer there. I want growth, but it's growth in pursuit of a profitable business over time. Okay. Now, I don't really care when a company pivots towards profitability, barring any shortage of capital being available, in which case the world changes pretty aggressively. But, if you think of the great example of this, and I do dislike when entrepreneurs compare themselves to Amazon, but ultimately Amazon spent about a decade losing money. And that made a lot of sense because, I met Jeff Bezos in, I think, January of 94. And it was pretty clear to me, he wasn't interested in owning the book market. He wasn't looking for a share of the book market. He was looking for share of your wallet. Yeah. And if he's going to get you as his consumer, and there's more consumers to be gotten and can be profitable with that over time, there's no downside to being on a growth trajectory where you're losing money today as long as you're acquiring customers that can be profitable. So often startups will get into a position, and this is a good position to be in, where they could be profitable if they wanted to, if they cut back on the growth engine. But at that point, you usually will find people like me that want to pour more money in, pour more fuel on the fire to continue the growth, because it's just as long as you can acquire customers in a rational way. And some of these terms get massively overused and sometimes aren't appropriate at all, but it is often a land grab. If you're the first person out there trying to disrupt the fill in the blank, I don't know, oil and gas industry, timberland industry, wood chip industry, pick anything, and there's no other competitors, then you're going to want to grab as many customers as you can as quickly as possible. And as long as that's all going to pencil out to a viable, high margin, profitable business over time. I mean, there was a company that I've been at two different funds, Canvas, which was a small $300 million fund, and NEA, which was a $3.6 billion fund. And we both invested in a company called MuleSoft. It was a great company for connecting all the APIs in one place, and their growth was phenomenal. The company went public. I do not believe they were profitable when they went public, and then they got acquired, and they weren't profitable then either. But the value of what they were doing was huge, and if they had chosen to, they could have become profitable at that point in time. But people value growth. But I do think people should understand it's not growth at any cost; it's rational growth. It is growth that pays for itself over time. If you come to me with a business plan, it's like, hey, if I spend $10, I can get a customer that'll pay me $1 for 2 years and then leave, but I can get a lot of them. Well, why would I care? But if you spend $2 and you get a customer that'll earn you $10, I want as many of those as possible, even if it means that it's going to take a while with losses to break through. So, it's all in the service of a business that is rational and profitable over time. Now, I will say that there is a pretty classic divide that I've seen over and over again between European and U.S. investors, in that U.S. investors favor growth. Some of them will favor growth at any cost, and I'm not quite there. And European investors, which are much more focused on getting to break even and positive cash flow in a timely manner. And, they're both logical approaches. They have different outcomes in mind. And they're in some ways, I guess I would argue, the reason I don't push my entrepreneurs, there are times like the dislocation created by COVID or 2008, when you look at things, and if the capital markets are not friendly and available to you and you don't have the opportunity to raise money, then it's irrelevant if those $2 customers will make you $10 if it takes you 3 years. So you have to be in a position to be able to shift to it. So, entrepreneurs need to have their feet and mind in two places at once, the present and the future. And so it's reasonable to be thinking growth, 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 while still understanding what it would take to be break even and profitable. Because if you run into a situation where capital is no longer available, which usually means that there's some problems in your business, by the way, you need to be in a position to be able to get cash flow positive, because then nobody can tell you anything about what to do because you have freedom. Cash flow profit, cash flow break even is the ultimate freedom to an entrepreneur.
Wow, time is going so fast, so we need to start wrapping up soon. I wish we had like hours and hours. We've been non-stop, but before going, you were mentioning about timing and going in the right direction, right time. We are here in the Nordics, and a lot of companies are very early starting on, then they're looking to growth and scaling expansion. What's your opinion or feeling on, let's say, U.S. markets you're more familiar with there? When should a Nordic startup kind of like approach or think or take like a U.S. investor and attack the U.S. markets?
Yeah, I think they are linked. I mean, there are certainly U.S. firms, U.S. venture firms that have become much more proactive about investing in Europe. Absolutely. And, NEA was looking at the European landscape, and I spent a bunch of time coming over, traveling, whether it was to Slush or to other events and speaking and getting to know entrepreneurs and getting to know investors. And what struck me was there were plenty of great businesses that would never need to leave Europe to be at the level and scale that I would have needed. I mean, you look at the Nordics had like 42 billion of public liquidity back in last year or the year before, and you've got these companies, these phenomenal companies, whether it's a Spotify or a Klarna, right? So you see lots of opportunity where you'll never need to leave your own borders, or maybe the borders of the EU. Having said that, I think while a lot more American investors have gotten comfortable with that, a lot do want to have the exposure to the United States for those companies. And I think a big part of that reason is that investors want to be able to add value, certainly early stage venture investors. Now, maybe private equity folks, later stage people are more open to being more passive, but it is very hard for it's not hard for a US-based investor to build a presence in Europe and to make investments in Europe, but in order to add value, we're certainly be able to magnify the impact we have if we're helping a company scale in the United States, where we've got a phenomenal network, lots of things we can do. So, I think that companies with global ambitions certainly would benefit from U.S. investment. I also think true hypergrowth companies in Europe that may never want to leave Europe, but want investors alongside that are going to support that journey of growth, even if it means sacrificing profitability in the near term, would benefit from U.S. investors. But keep in mind, the farther you are from somebody, the higher the bar, right? It's gotten easier because all these little squares of glass have allowed us to communicate so much more readily and equally all the time. But the farther you are away from each other, the more disconnected you become, and so the bar goes up. So, if you were a company that could just barely squeak by with a Series A as a U.S. company, it's unlikely that you as a Nordic company would be able to just squeak by. It would probably just be a little too hard. But when you're sort of, it's sort of like the old saying about the best time to borrow money is when you don't need it. So the best time to raise from a U.S. investor is when you've got plenty of investors available in your home country. Because then, you already know you've checked all those boxes, and then it's a question of how do you find the best possible partner for you? And if that hyperscaling expertise and support is useful, then that can be a big part of it. Also, admittedly, U.S. investors tend historically to pay higher valuations. Now, I've noticed that European investors are catching up, and I used to think I'd get a better deal when I went to Europe. But I remember one of the first companies I went to see, it was like the European version of a famous U.S. startup. And then they told me their valuation expectation. I was like, wow, that's high even for what I'm used to. But, you know, the world has gotten very flat. People have gotten very accustomed to sort of the way things work. And so the best investors and the best entrepreneurs get together and numbers can get pretty crazy. You know, I got an unsolicited email the other day from somebody that was telling me about their advanced methodology for startup valuations and blah, blah, blah. And I almost laughed out loud. It's like, there is nothing more subjective than startup valuations. You know, and when my entrepreneurs ask me what's fair, like when they're going out to raise, I always tell them, fair is what you negotiate, and the market will set that price.
All right. Hey, Ben, it's been a great pleasure, and we're looking forward to seeing you in Europe again whenever the situation is okay, and maybe we'll get some European portfolio companies for your new fund in the future also.
And everybody watching, you should go to pitch-ben.com and pitch me your ideas, and I can come back and give you my feedback.
Okay, super, fantastic. Thank you so much, Ben, and have a wonderful day.
You too.
Bye. Bye-bye.